Hello everyone, this is Ted Bauman, editor of the Bauman Letter here at Banyan Hill Publishing. Have you ever wondered why it's possible for you to sell or buy shares in specific companies pretty much any time during the market day without there necessarily being a buyer who wants to buy the same number of shares or sell the same number of shares? Well, it's simply because there's a kind of financial institution known as a market maker that provides liquidity. It essentially acts as a middleman between buyers and sellers. And it does that by keeping certain shares in reserve. But to do that, it has to devote part of its money to that process, and it makes a little bit of profit on it, but it doesn't make as much as sometimes it can get in other forms of speculative activity. Recently, we've seen a pullback in the amount of liquidity that's being made available in different parts of the financial system. So I made a little animation to show you how liquidity works and to show you what can happen if liquidity is withdrawn. Now here's a chap who wants to buy some AT&T shares. He's looking at the prospectus, he likes what he sees. This bank has some shares of AT&T it keeps on hand. That provides liquidity for AT&T shares so people can buy them when they want to buy them. So there's a guy out there who wants to buy AT&T shares, but he only does it later in the day. The bank makes a tiny profit by facilitating the transaction with its liquidity. It's known as a market maker. That's why buyers and sellers can transact at different times during the day. Now, this guy wants to sell some shares of AT&T, but the bank's offered buy price is too low. He's going to lose money if he sells at this price, and besides, the price he sees on the market indexes seems higher than that. That's because the bank is using its money to do more profitable things than supply liquidity to the stock market. Maybe it's speculating on mortgages or other kinds of derivatives or something that makes more money for the bank. This lady wants to buy AT&T shares, but she doesn't know that there's a seller who's willing to accept a lower price than what she's offering because the bank has limited its liquidity actions. So this guy has to accept a lower price for his AT&T shares, even though there's a buyer willing to pay more for them. So there you have it. That's what liquidity does in the stock market. Now, the important thing about liquidity is that it allows people to transact at reasonably close to the same prices that they see listed on the stock market on websites during the course of the day. If liquidity evaporates, you might see very different prices offered to you. You may even find it difficult to liquidate shares simply because the bank is not interested in buying as many of them as you might want to sell. And for that reason, they offer you a lower price. That can happen even if there are buyers out there who are willing to buy them at the price you're willing to sell them for. Now, that would seem like something that shouldn't happen, but it does, and it happens because liquidity is essential, but it is provided by profit-making institutions just like banks or anybody else. Now, to protect yourself against a decline in liquidity, what you need to do is look at your stock portfolio and see the average trading volume of your stocks over the last 30 days. It's usually possible to get that information from almost any good stock market website. Where you see stocks that have low average trading volumes, you can be sure that those are the stocks that are going to be hit by low liquidity problems first. So if you think that you might need to liquidate stocks in the future, let's say maybe to make your required minimum distributions from your IRA during the course of the year, you might want to earmark those stocks to liquidate first so that you don't run into liquidity problems. Alternatively, what you can do is look at the low volume stocks that you have, wait for them to reach a peak, and then sell them early before liquidity problems start. Now, I know it's hard to predict when that's going to happen, but it has happened in the past, particularly when there are financial crises. That's because when we do enter a financial crisis period, banks tend to circle the wagons, they bring their money back and focus on maintaining their capital reserves, and they withdraw them from alternative uses like providing liquidity by being market makers. Now, we never know when that's going to happen, but if it does, the key thing is to understand the mechanism and either to liquidate what you need to liquidate before there's a liquidity problem, or wait until the problem has ended and do it afterwards. Otherwise, you can end up earning a lot less on your sales of your stocks than you could otherwise. This is Ted Bauman with your Sovereign Investor Daily Video. I'm the editor of the Bauman Letter. Please make sure you check me out on Twitter, Facebook, and various other social media platforms. And also look for me in the press. I've been quoted quite extensively recently. Most recently, I appeared on Fox Business News talking to Stuart Varney about the IPO boom particularly why WeWorks didn't boom at all. This is Ted Bauman signing off. Take care.